if you're interested in investing passively, we'd love to have a conversation. Our investing company is called Nighthawk Equity. You can go to nighthawkequity.com, click the join button, and schedule a call with us and explore if investing in our next syndication is for you. Again, we'd love to have a conversation with you. Also want to do a quick shout out for Dustin, who left us a review on iTunes. And he says, abundance of knowledge from both hosts and guests. If you think multifamily is the vehicle for you to build wealth, this podcast is an absolute must. So I appreciate that as well. Typically what we do is co-host Garrett and I, we will banter about something related to the market and the industry. And so kind of give you up to the minute knowledge of what's going on right now. Also, we want to highlight people who do their first deal that have been influenced us by us in some particular way. And this week, it's going to be Chesley Garber. She was actually a mentoring student of Josh Eitinger, and she closed her first deal in August of last year. It was a 51 unit. It was $2.5 million with a capital raise of 1.5. And the reason it's a little while ago is because we had Dealmaker Live a little while ago, and we had 10 people there on stage for first deal. And at the event, we discovered another 20. So there's a lot of people that are doing deals and making use of our programs and things of that nature that we just don't know about them. But more back to Chesley. And so in November, which is literally like 3-4 months later, she closed a deal that brought her to financial freedom. It was a 192 unit that she bought for $13.5 million with a raise of $3.5 million. Now, do you think she did that on her own? No, of course not. She had partners. She also had a mentor, and those are the keys. And we're going to get into that in the show as well. Both having a mentor and a partner, absolutely key to doing deals that are $2.5 million and $13.5 million. So if you're interested in our mentoring program, head on over to themichaelblank.com/mentor. You can schedule a call and just explore if mentoring is right for you. And it may be right for you if you want to accelerate your results, do bigger deals faster, and avoid some of the bigger mistakes. So we'd love to have a conversation with you around that. Now with that, let's bring in our co-host, Garrett Lynch. What's going on, Garrett?
What's going on, Michael?
So what should we talk about today, Garrett?
Let's talk about the Fed.
The Fed. Okay, that's a good one, right? Because we're all concerned about interest rates, right? And so they're going up and they're going up and they're going up. I think the Fed is bluffing. In fact, I need to have an Instagram post that says the Fed is bluffing.
Really?
Yeah. Well, yeah.
Well, they didn't.
Yeah.
They weren't bluffing a couple weeks ago.
Well, so fair enough. They did not bluff a couple of weeks ago, but if you look back at a year ago when inflation started coming up and the Fed basically was denying it, and then they finally said, oh, it's transitory, right? Obviously, it's not transitory. And I was watching this. There's no way this is transitory. I mean, I was listening to some like Peter Schiff, for example. I listen to him once in a while and just observing what's going on. I was like, dude, these are massive problems. This is not transitory. So the Fed is either lying or they're incompetent, just in general, just by that experience. Also, they're also responsible together with the U.S. government for all this quantitative easing, which created this inflationary mess. So I don't know. Again, they're either lying or incompetent. But in this particular case, they did raise the interest rates by 0.75 of a point to 1.5%. They're probably going to do it again between 0.5 point and 0.75% next time. So they're going to end up at a whole whopping 3%. So number one, back in the early 80s, when inflation was like this, the interest rate had to go to 16% before inflation came back down. And they're threatening of going to 3%. And there's no talk about anything beyond 3%. And the reason there's no talk beyond anything 3% is because unlike in the early 80s, where we had just under $1 trillion in debt, now we have $30 trillion in debt. So if the Fed were to raise it a full 3% from where it was at 0% 18 months ago, debt service is going to be the single biggest U.S. expense. It's going to be bigger than all defense spending in the entire U.S. world. It's going to be bigger than Social Security that we're paying out as well. It'd be the single biggest expense. Therefore, the Fed actually can't afford to raise it much higher than 3%. Here's what's going to happen, Garrett. Here's what's going to happen. They're going to raise it to 3%, and they're going to threaten to be aggressive against inflation. Rich, even if they were to raise it to 8%, really wouldn't do anything to bring down inflation. Okay, so number one, 3% is a blip on the radar. But like I said, because debt service is going to be so expensive, we are not going to be able to afford our debt. And so we might be in danger of defaulting on some treasuries if we get much higher than that. And number two, these 3% interest rate is going to create a recession. In fact, some people already think we're in it, and that'll be probably later this year. There's argument how deep it will be, but then what does the Fed do in a recession? What did they do in 2008 and what did they do in COVID? They go back to quantitative easing. So what they're going to do is they're going to lower interest rates and print more money. And this, of course, fuels inflation. Now, I don't like inflation. I don't like what it does. Okay. I do like it for real estate. So if you guys listening and watching this can be in real estate, then you must be in real estate because it is the biggest inflation hedge that we have. I mean, inflation drove up our rents by 20% across the board last year. And it's going to continue doing that. And interest rates, even if they're rising, yes, our debt service becomes slightly more expensive, but it's not nearly going to be as high as inflation. So this is kind of what I think. I think interest rates are going up. There's going to be a ceiling to how they can go up. It's going to create a mild recession. And then we're going to go back to quantitative easing. And so in the meantime, inflation is going to be really high. So what we got to do, Garrett, is we got to figure out how to get ourselves into deals in the next like month or two, because it's a little challenging right now with the debt markets. But then medium term, it's going to be magical once things settle down a little bit. And even if there is a mild recession and some people may lose their jobs, it's going to drive people into rentals because they can't afford buying a home anymore. So for rentals itself, it's going to be good. So I remain pretty bullish on that. But that's my outlook for interest rates. Since you asked, in the Fed, those knuckleheads.
Yeah, I think that's a good analysis. I think that there's still a supply shortage for rentals, which means that there is a demand to rent, right? And then layer on top of it the supply shortage in housing, just in general. There's a really strong case for the fact that rents are still going to stay extremely strong, and inflation just pushes things upwards. So if you're an owner of real estate, you're seeing all the positive impact and effects of that, of course, because the question is, where do you put your money at this? It's getting eroded by inflation. You don't want to put it in the stock market. You see what's happening there, crypto, all these other things, but the one that still remains strong is real estate. And then layer on top of it the best asset class inside of the real estate umbrella, which is multifamily. We're talking about a good thing right now. I definitely think that your analysis is what I've heard different opinions, but I tend to agree the most with what you just said, Michael. So good rants right there.
Thanks, man. Well, through my restaurant debacle, I've grown much more skeptic and cautious than I was before. When I got into restaurants and I plowed my net worth in restaurants, I only had happy ears on. I personally guaranteed my leases, and what could possibly go wrong? Well, it basically went all wrong. So it's not that I'm, looking at this, with blinders on. I'm still very cautious. We still got to get into these deals right. We have to underwrite them right. We have to get the debt right. Okay. And so I'm still skeptic, and I do want to know, what are we possibly missing? But if I look at all the facts, getting in a multifamily in the medium term is fantastic. We just have to get it right in the short term. So that's kind of how I feel about it right now.